a nosedive in profit and a spiking dividend. A very interesting story there of Kenya Reinsurance Corporation. Good evening. Many thanks for joining us. Later on, I'll be talking to Churchill Ogutu. He is an investment analyst at Genghis Capital. And of course, we'll be trying to find out how is the market performing and what it means for you. But for now, Jadiah Mwarania is the managing director, Kenya Re Corporation. He's now joining us on the set so that we can get to understand where Kenya Re is going from here. Jadiah, it's nice to meet you.
You too.
Yes.
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 Thank you.
Good. Now, you have been in this business of reinsuring others, for close to 50 years now, since 1971. How would you term, or what is the current business environment, if I had to ask you so?
The environment is very competitive. Nobody has got monopoly of business as it was in the past, sometimes, especially for Kenya Re and other early the reinsurance companies that were set up early, immediately after independence. It's a competitive environment, but we like it because it is actually that competition that makes us, effective in the production of new products and being innovative. So it's exciting as far as I'm concerned, because we are trying to offer a product to the market based on the demands of that market and based on what competition can give. So it's competitive but exciting.
And you operate in 2 continents with a combined country force of about 65 countries.
Yes.
You have business there.
Yes.
And how would you compare the business environment there with the business environment here in Kenya?
Quite similar, because the same principles of reinsurance apply. It is the same facultative business that we do, and it is the same treaty business that we do. But if you look at the environment and the practices, you see a lot of differences. For example, in Asia and Middle East, the kind of premium rates you find will be considered thin compared to what we have in Africa. The kind of loss ratio, claims record that you get is also higher compared to Africa. So for us, we focus, as Kenya, we focus on Africa, Middle East and Asia, but we always say preference is to the African business. We believe we understand Africa better. We believe that there is a lot of scope for growth because of the low penetration rates of insurance, 3% in most of the countries except South Africa. So we think there is comparison in terms of, comparability in terms of the principles, but the environment and the profitability of the business we do, our preference as Kenya will be more on African business.
And when you scan the African environment, where do you see the biggest potential for growth for your business?
I would say we are very strong in eastern part of Africa, but we are spread across. We've got a regional office which is set up in Abidjan to cater for Francophone markets, which is West Africa and North Africa. East Africa is strong because we have been here for a long time, and even in terms of the spread of the premiums, also the East Africa tends to be strong. Southern Africa, we've just opened a regional office in Zambia to take care of those markets in terms of service delivery. And for the first time, we've got now a retrocession program which allows us to do business in South Africa itself. So we'll be exploring other opportunities which we can find in South Africa as a country and the southern region in general.
And we know for sure that the insurance industry here in Kenya is highly concentrated on the motor industry. And this is where we have a serious problem with undercutting challenges. I don't know how you have been impacted by this as a company.
The portfolio, if you took the entire business or insurance business in Kenya and even reinsurance, and then you get the proportion that is motor, yes, the proportions will always be high. The average insurance company may tell you their motor portfolio is even 60%, 50% is, and 40% is normal. Now, what happens with motor is that, especially where you have PSV involved, and sometimes even private car, the loss ratios tend to be high. If you put undercutting in there, undercutting means that you're charging actually a premium which is less than economical rate in terms of what you should be charging. You're actually underpricing the insurance. It means you're collecting less premium than you should collect. And reinsurance insures insurance companies. So if at the primary level, at the insurance company level, you didn't collect adequate premiums, it means, of course, less will flow into the secondary or tertiary or insurance market. So the effect is direct, that when there's undercutting, there's less premium for both primary insurance companies as well as reinsurance companies like ourselves.
And how best do you think we can deal with this problem, because it's really affecting the insurance industry in Kenya?
I think the professional associations have a role to play. A key in this case, the Association of Kenya Insurers, the Association of Kenya Reinsurers as well, in terms of inculcating discipline and practice of professionalism in their members, because face it, there's nothing smart about undercutting. Everybody loses with undercutting, and the incentive to undercut is probably to get an additional piece of business from the same client. But at the end of the day, as a company, you should ask yourself, is it making sense in terms of adding to your bottom line, the profit? And the answer is no. So I think the enforcement of regulatory requirements, of course, every company files in minimum premium rates with the regulator. I think enforcement of that would help a lot. The associations, especially the Insurance Association of Kenya, as well as Insurance Association of Kenya Reinsurers, enforcing and making sure that nobody is undercutting the neighbor, is a way of doing it. Training, we do a lot of training to try and inculcate professional practices within members of staff of various insurance companies, because even insurance companies should understand, and actually they do understand, that when you undercut, you're actually eroding your own value. Yeah.
And let's talk about marine insurance, which is now, the pet topic for all insurance companies, starting this January. Do you see potential there, and are you eyeing a piece of this market?
Yes, there's a lot of potential. It is estimated 20 to 25 billion of premiums actually is what can come out of the marine at the primary level, at the direct insurance level. We had a lot of expectation that a lot of this would crystallize. The law is clear that marine insurance should be insured within the country. For a long time, that has not been happening. And the Cabinet Secretary in charge of Finance was right in pointing it out the year that passed, that this should be localized. We support that move. We have had discussions as an industry with various stakeholders, including the regulator, where all of us are agreed that's the way to go. It may not have exactly kicked in this first year as we expected, but we believe, out of the many other discussions subsequent to the renewal season for this year that we have had with the regulator and other stakeholders, we believe next year, 2018 renewals, we will see quite a lot of that 20 billion remaining in the economy.
And when you look at the insurance industry, we have a lot of local insurers insuring with international companies. Is this lack of confidence with local insurers, or what is happening?
Not really. I wouldn't say lack of confidence. To start with, reinsurance is international, very international by its nature, because the principle you're talking about is spreading of risks, and the spreading of risk is including geographical, and especially geographical actually. So it is normal that you can't have a Kenya Re that just does business in Kenya, or Uganda Re that just does in Uganda. Spreading out the business is normal. And traditionally, all the insurance companies that are from out there have been doing business here, so they have a stake or a cake of that business. I don't think it's because of lack of confidence or lack of capacity locally. By the way, I should also say that the smallest insurance company can insure the biggest risk in the world. You don't have to reinsure based on your own balance sheet or asset base. You can use retrocession or insurance, so you can package a nice reinsurance for yourself. I think it is just that some of the business, out of connections, for example, multinationals whose mother country might be in the UK or in Europe or in the America, might be preferring those reinsurers, or may have an insurance arrangement already made from out there. But it's not for lack of capacity. There's a lot of capacity with the insurance companies in Kenya, and that capacity can actually be increased overnight through buying retrocession.
And this is a question that I have always grappled with. Why do you think the insurance uptake in this country has remained at less than 3% for quite a long time?
Very, very many reasons. And first, we must say that for Kenya, actually, at 3, some figures even put it at 3.5. If you combine, I've also seen statistics talking about 2.8. Is actually normal by African standards. A lot of African countries are below that. The exception is South Africa, where life penetration rate is up to 14%, the highest in the continent, even higher than some countries in Europe, actually many countries in Europe. Now, reasons why penetration remains low is what we always know: economic power, because insurance is a service which, when the financing or the economic power is not there in a household, it's quite easy to dispense of with. There is the element also of education. People may not have fully understood the importance of insurance and the need to have that insurance. There is also the aspect that not many insurance classes of business are compulsory in Kenya. Like it's only motor and probably workman compensation. And the perception of people about insurance, the mythical stories that we may have had in the past about people not understanding it and probably thinking it is not true, is something that has kind of continued to depress the uptake of the of insurance.
And we do hope that insurance companies are addressing these, what we call the crisis of confidence. Finally, as we wrap up this interview, I want to find out from you, Kenya Re is 60% owned by the National Treasury, 40% owned by other investors. There has been a long dry spell on the NSE for IPOs. Would you advocate for a piece of the 60% owned by the government to be floated to the public?
Maybe it is the shareholders who would probably talk about that, but what we find, what I would comment about is what we see in the market, that we seem to see demand that is outstripping supply in the case of shares of Kenya Re. And we also seem to see a competitive environment that requires probably faster decision making, probably with less red tape and control. And we also see a Kenya Re that is very dynamic, that is operating in a private sector market, that is asked to respond to customer demands and customer requirements quickly, quick turnaround, and probably it would be desirable to reduce the stake. But that, of course, decision ultimately lies with the government. Probably it can be incremental. We can probably suggest a decrease of 20% and see how it goes as the government takes stock of the situation. But it truly is a company that needs to be released to private sector environment and operate, which it does, like any other private sector company, without probably too many regulatory restrictions.
Very good.
Yeah.
Jadiah, thank you very much indeed for joining us here on the Trading Bell and sharing your insight with us.
Thank you very much.
Jadiah Mwarania is the Managing Director, Kenya Re Company, joining us here on the Trading Bell to help us understand and give us an insight as to the reinsurance industry here in Kenya and, of course, abroad. You're watching the Trading Bell. We are back shortly. The performance of the Nairobi Securities Exchange for the last 1 week. Churchill Ogutu is an investment analyst at Gengis Capital. He's joining us here now to help us put the figures into perspective. Thank you very much indeed, Churchill. First of all, I want to hear from you. What is your reaction to the M Akiba bond that closed yesterday, and how do you think is likely to stimulate the market?
Yeah. The M Akiba bond that closed out yesterday, I think it's something that is geared towards the small end of the market, meaning at a minimum amount of 3,000. This is not geared mostly to the high end of the market, but geared to the small players in the market. It will go a big deal to stimulate them, demystify the bond market. Currently, the minimum uptake is at 50,000, but at 3,000, it's also enabling even the mamambogas. People actually with a mobile phone, you can now be able to get into access into the fixed income segment here. The return that it was being given is at 10%, which if you compare with the minimum deposit rate given by the banks, it's at 7%. So you'll find that more people will actually be getting into there. It's a tax-free bond, remember, so it will be attractive to the people on the lower end. I'll
Very
say this is the first phase of it at 150 million shillings. 3 months down the line, we'll see the second phase of it being launched at 4.85 billion shillings, which will sum up to 5 billion for the whole bond of it. So I think it will be able to, in the interim, it will be able to generate a bit of some interest. There'll be a bit of some investor awareness towards it. We saw that there's a bit of some capacity limitations from M-Pesa. The maximum is around 140,000 shillings. So it will be able to give it some room to have some expansion into it.
Good. And now turning on the market, when you look at the three indices of the market, save for the NSE 20 share index that dropped by 0.68%, all the other markets, the two other markets have appreciated by between 1.23 to 1.7%. Do you see the impact of M-Akiba in these?
Not necessarily the same. I think this is more towards an exuberance. This is a new quarter we are starting, so it's a bit of the headwinds that you saw in the first quarter is sort of being fading out, so it's a bit of an exuberance within the investors trying to get on board. And also some of the stocks that we saw that they had actually had been waning in the last quarter. We see a bit of some investor interest coming back to the market. So I think it's not something entirely related to the M-Akiba bond listing.
And I'm somehow attracted by the, you know, the top losers counter. I'm saying BAT, I'm saying Barclays Bank, I'm saying Williamson Tea, I'm saying Portland Cement. I don't understand. Why do we have Barclays Bank here and BAT?
Well, I think this is more to do with profit taking amongst investors. If you look at the BAT stock, it's last week it was trading at 899 shillings. This week it closed at 830 shillings. So it's a bit of profit taking within that stock. Barclays, the same. The banking stocks, we saw that it was coming to a low valuation, so a bit of an uptick in the prices. But right now we're seeing investors coming out of it. In terms of the Williamson Tea counter, one of two things coming into play. The first one is the profit warning that it issued towards the tail end of last month, which is somehow impacting negatively on this stock, and also the drought effect that actually has reduced the tea volumes is playing an impact. People are looking at it that the revenues will actually be slimmer than we saw last year.
So when you go to the top movers counter, we have KCB, Kenocor, the two of them, I think, moving almost 40% of all the shares that were moved in the top movers bracket. Why do we have KCB and Kenocor there? And Kengen actually?
This is majorly, the three stocks are actually being driven by foreigners. There's a foreigners demand into these three stocks, in particularly the KCB stock. So this is something which has really pushed upwards the price of the stocks. Yeah, we've seen in particularly KCB has been net buyers amongst the foreigners, so it will be something which will bolster the price going forward into the coming week.
Very well.
Yeah.
Churchill, thank you very much indeed for joining us on the Trading Bell.
Thank you a lot.
Churchill Ogutu is an investment analyst at Genghis Capital, joining us here to help us understand their statistics and of course put them into perspective. You're watching the Trading Bell. Stay right here.
My name is Japhet Onyango. I would like to know about green bonds. Yeah, what are green bonds?
A green bond is a particular type of bond investment that is tied to a green project, mostly environmentally friendly projects, low carbon emission projects, and also the forest projects. This kind of a bond is tax exempt.
Well, and on that historical perspective of the NSC, we come to the end of the Trading Bell TV program for today. Many thanks indeed for your time. My name is O'Brien Kimani. We'll look forward for the same company next Thursday right here on KBC Channel 1. In case you want to get in touch with us, our SMS line is 22162. Always remember to start with the word BIZ, that is B-I-Z. My Twitter handle is @O'Brien Kimani. At the Trading Bell TV show is our Facebook page, and at KBC Channel 1 is our Twitter handle. Always remember to get in touch with us. So we'll see you again on Thursday next week. From me and the rest of the Trading Bell TV crew, have yourself a good night. Back to you, Broadcasting House.